Good afternoon, everybody, and thank you for assisting to this webinar presented by SSQ Insurance. My name is Matthew Roy, Investment Fund Analyst at SSQ. We are pleased to welcome today Johnny Quigley, Senior Vice President, Institutional Investment Services, and Christopher Guthrie, President, CEO, and Senior PM for this webinar on adding U.S. small cap equities to your portfolio. Please note that if there's enough time at the end, it'll be our pleasure to answer one or two questions that you can ask via the Q&A section. You can also communicate with your SSQ Insurance representative for all other questions. So without further ado, Johnny, the floor is yours.
Well, thank you very much, Matthew. I appreciate very much, and thank you everybody to be here present today for this little webinar. I think as the title Matthew brought in is, have you considered to add some US small cap to your equity portfolio? This is a presentation we will cover that part there, and why you should maybe start thinking of adding such an interesting asset class into some of your clients or your prospects at that part there. For presentation, we'll be covering many points, but trust me, we'll be able to do it in the time that has been allowed to us. We'll give you a kind of flavor who is Hillsdale, why you should consider looking into US small cap as an investment, the approach active versus management, mostly in small cap space, something very interesting to consider. The product that we are actually managing for SSQ, a really interesting approach to how to benefit of adding in some US small cap into your portfolio without taking any additional risk. We will also give kind of a little outlook of US small cap, what to come and where to go, the classic little summary recap. And I guess Matthew mentioned to you, we will be open to questions a little bit later on. So just to put you up about Hillsdale, who we are. We're Toronto based, we're partner owned. We oversee roughly $3.9 billion in equities, only equities, no fixed income. We do Canadian, US, and global equity strategies, mostly for sophisticated institutional investors such as SSQ, managers programs, or in some institutional pension plans or endowments. We were founded in '96. We have roughly 24 years of successful experience in the equity space of active management. We are active, and trust me, we work very hard on that part there. Just to be sure that our interests are in line with our clients, we also have our own money invested with our own strategies. So when our client goes through pain, we also go through pain, and it's always good to, obviously, we share this level. So at least when we're talking with our PMs or between ourselves, we understand what's going on and how we need to communicate that to our prospects or clients. Just to give you a few flavor, we are fundamental quant. So we have our own proprietary research engine. We cover over 40,000 companies around the world. And with this approach and all that, it helps us to, I would say, design and support strategies for our clients, such as SSQ, to achieve the investment objectives that are being fixed on the long run. We're a bit kind of like Darwin. We're adaptive investment approach. We believe in the best of fundamental, quantitative, and capital research. So we look all the cornerstones, we look at them and try to be sure that we're always in place. We've been working with SSQ since April 30th, 2012. So nearly over roughly a bit more than 8 years dealing with those guys. And we appreciate very much the business they give us and the communications we have with SSQ. They're very active and very, I would say, knowledgeable on the equity side. This new product, we have put it in place as of November 7th. Because the other product that we had with them had some leverage and some shorting, so we could not bring it into certain markets. So we put this in place. We added in some small cap and another strategy. And since 2015, this is the product that's being, I would say, used by SSQ on their platform. As I mentioned, we're independent, partner owned, and client aligned. Our $23 million aligned with our own clients, 80% owned internally by our own partners, people working at the firm, and all different prospects on that part there. And we do have a private investor, which is at 20%. It's a good mix for us, we find. I mentioned we are small, but at the same time, we're institutional boutique. We're uncovered by the size of assets. We are willing to close and soft close some of our strategies. As you notice, our number one strategy that we put in place is really in the small cap space. So Canadian, US, and global small cap is a niche for us. We have the return premium strategies, which is focusing on quality, value, yield, momentum, or in some cases, risk. These are strategies that we're seeing more and more with specific large institutional pension plans that are looking for a kind of way to diversify their approach of portfolio. We also offer all cap and core. We have also what we call return absolute strategies where we put in place alternative approach to manage that part there. As I mentioned, we are specialized in small cap. 24 years is starting to show where our hairs are getting grayer and grayer. And if you look over time, you could see that also we achieve our investment objectives. So we're able to generate an alpha or value add versus our benchmarks that are very interesting. But in the same time, over the long time, we try and be sure that technically we're able to, I would say, maybe match or outpace our peers in many places. And over time, you could see that in the long run, we're able to keep ourselves at the high end. It takes a bit of time, but usually our strategies do creep up in the universe. And with time, we become first quartile over the long run. And like we say, small cap is a kind of a growth asset. So you have to perceive that as a long-term investment, 5, 7, or 10 years. These are things to look into. Now, the question is, why invest in small cap US equities? Why should you go there? Well, I would say there's about 5 reasons you could bring to your clients or prospects to look at this asset class and such. First of all, let's be honest, the US small cap universe world is pretty big, but even the small cap in its own peers universe, a small cap is still a very interesting universe. It's not something you should neglect. It's something you should look at. There's also the benefit of adding more securities. There's a breadth there. There's something worthwhile. You have it. I think of all things, small cap is really a kind of a tilt to growth, something against inflation. So it's really there for the long-term performance. You're there for the long term. So that's a kind of an asset class you should consider. Also, the potential of alpha or the value add is very interesting in this space. So this is something you should look into, capture. And I think that's what maybe attracted SSQ to Hillsdale is our capacity to generate alpha or value add over time. And the latest one, I think, was something very interesting and something important for a lot of you guys when you're talking with your clients or prospect is how, if you have an exposure to the US, is how can you reduce your bias? There is a bias, a market cap bias. It's very interesting, and it could be very painful in the future. It helped out for the last 2-3 years, but like we always say, sometimes it's kind of a mean reverting. It could come back, and the backlash could be pretty bad. You see, as I mentioned to you, the universe as such. I mean, if you look into more, I would say, well-established markets, such as technically the MSCI World, it's a big thing. We're talking here roughly about $41 trillion, nearly $42 trillion versus the smaller cap, which is roughly 5.4. So yeah, it's 8 times bigger, but still, if you look in the small cap space, what's interesting is you have a number of names there, roughly 4,239 names in that index. And out of those names, there's about 41% that are US stocks. So 41 is roughly 1,700. It's not negligible at that part there. Plus, if you look at the allocation, the country weights, the US, as in the well-established markets, is present. It's something you could not neglect. So if you're really going into the small cap space and you're not going for a global approach, the US is the best proxy you could have at that level. Secondly, I mentioned breadth. Well, let's be honest. I mean, as Canadians, everybody knows the TSX Composite, which was in the old days the TSX 300. Well, it's about 250 names. The larger cap names is 60. It's 60 names, and that's it. You don't have much more nor less. Then you go into the US, you're going more to the large cap space, which everybody knows the S&P 500. Even some might be looking at the Russell 1000, but still we're talking just 1,000 names. So yeah, it's interesting, but still the breadth is I would say marginal compared to when you get into the small cap space. If you go into the global space, you have roughly 17,000 names. And out of those 17, there's roughly nearly 2,800 that come from the US universe. So the US on such is very interesting. And my colleague, I know he's going to be able to join us, he had some little technical problems. The Canadian small cap, which he's been managing over the last 24 years, since 1996, he worked very hard. He's up to roughly, he found nearly 3,000 names that he's able to look into his portfolio to add names. And with this breadth over time, we were able to make some nice, very value add. So this is this kind of a secret thing where you have to look at the number of names and the potential to generate value add comes from that breadth that brings into those markets. As I mentioned to you, we're here for the long term. And if you look at the technically small cap, yes, it's maybe a bumpy ride, but over time, since roughly 27, we could see that the market is always going up in certain ways, but at the same time, it's outpacing the large cap space. And this is the most important part because usually large cap is interesting, but if you're looking for growthy stocks, more growth, you're getting roughly another 190 basis points just by going into small cap stocks. And versus the inflation, you're getting a kind of a net value of roughly 9%. So it's not negligible that part there. At least it's interesting, but it's a long time race, and you have to be really there for a long time approach. Now, which is an interesting part. I mean, a lot of people talk about value add, and let's be honest, small cap is the place where you have the most potential value add, but still in the same time, this is where the people put less money in. I mean, everybody's willing to pour into the US large cap space, Canadian large cap space, but the potential value add is not very, very big. And usually fixed income, we understand a good manager is able to give you between 25 to maybe 50 basis points above the benchmark. And there's a natural thing, but still it's not compared to the small cap space where you need to get obviously between maybe 150 to maybe 350 basis points of value add in a very simple way approach. So it's very something to look at, but still at the same time, people do not allocate that much money to that asset class, and they're maybe letting some money on the table without looking at it in a very deep way. I was talking about a bias. Well, look at this bias here. I mean, let's be honest. Actually, there's 122 holdings in the S&P 500 that represent 75% of the market cap. So when the market is up, it's because one of those 122 names, and that's it. I mean, that's the whole concentration part these days, is these names are really pulling up or pulling down the market. The rest, let's be honest, they're just there on the bandwagon, poor them. They're not participating that much. So it's not easy to be able to outbeat that kind of index if you really have to just play against 122 names, and that's it. Secondly, if you look at the market cap, you're up at $396 billion of market cap weighted. But if you take the average, you're chopping it down to 55. And if you take the median, which is you have roughly nearly 250 above, 250 below, you're down to 22 billion. So there is a big, big difference. So if sometimes just by going the classic easy way, acquiring ETFs and all that, just be knowledgeable that you're putting more and more money into the same names. You're increasing those 122 names. And some good day, a bit like in the old days when we had Nortel, when it goes good, no problem. When it goes bad, we know what happened. It goes really down. So you have to be sure that technically you understand that by pouring in money into the S&P 500, you're concentrating that money into the 122 names only. Out of those 122, there's 20 that we are showing you here. And if you look at that part there, there's about 20% that are in 4 names: Apple, Microsoft, Amazon, and Alphabet. So yes, there is a kind of a concentration, and you see that it's very big at that part there. So these names are driving the market. Actually, it's a good thing because with COVID, the pandemic and all that, they were able to profit that part there. But once, like I say, the part is going to be over, what's going to happen? This is the question mark. A lot of people will start re-questioning their allocation to those names, and maybe it'll be time to start putting up money. So on average, you look at the top 20 names, they represent roughly 30% of the market cap of the index. So that's very, very high. And there's 5 names that have over 500 billion. So there's some countries even smaller than 500 billion. So you could see these are very dominant mega cap names in that index. The other question we get many times is management, active versus passive. It's for some people, the passive way is the easy way to control, I would say, costs and that. But at the same time, it makes sense on the short term. On the long run, I'm not too sure. And secondly, when you get into the small cap space, it's a different picture. The best opportunity set that you could have for an active manager is really in the small cap space. This is where you get the breadth, you get the skill, and the odds of success are, I would say, higher than anything else out there. So if you look at time fixed income side, the breadth, it's very low. Skill, it's not easy. Everybody has the same names. Everybody understands the same names. And the success ratio is low. And you see it. Between average, a good manager will generate between 25 to maybe 40 basis points above the index over the long run. So it's very, very complicated if you're into the large cap fixed space. But if you're going more down the spectrum, such I call the small cap. So the US global and Canadian small cap space, they offer breadth, as I showed you a few slides before. Skill does kick in because you're able to follow better names, find other differentials, and find some inefficiencies that are part there. And by doing that, it increases your odds to add value. So you have a higher potential of success in those kind of things at that level. Now, the reason why you see this kind of a success in the small cap space is the coverage. Let's be honest, more and more brokerage firms and companies are less covering the smaller cap names. Everybody likes to follow Amazon, Microsoft, or Apple. But when you get into the lower space, these names are being neglected. And let's be honest, the number of analysts or CFAs and other individuals following those securities is very, very low. So the ones that are willing to do time and dig up those little names, it's maybe a lot of work, but over time, they should be able to create value on the long run. And that's why I say it's always a question of timing. So we're talking here between 3 to 5 years. And after that, it's this where you start really getting the best parts of those companies and the growth. I mean, everybody knows you start somewhere. I mean, Microsoft didn't start at the size they were there, Amazon also. So it does take time, but you have to pick them up before they become the big players or the big stock names in the market. The median manager annual excess return, we look at it over time, and the potential of adding value is different from each asset class. Canadian fixed income, like I mentioned to you, it's about 20 basis points. US, if you're a good median manager, you're about 60 basis points over time. The global equity guy gets about 130 basis points. Emerging markets and all, it's about 160 basis points. But when you get into the global small cap space, this is where it's getting more richer. You get about roughly 180, and that's always a median manager. So there's 180 US small cap, 210, and in the Canadian small cap space, which is a very strange market, very inefficient, but very hard to, I would say, find the right names and keep it over time, you're able to add roughly 630 basis points. So you see that in the global small cap space, the potential is there. And that's where you have to look at small cap as a kind of a long-term good value add. Now, we tested up to see if that's something possible. I mean, we use investment as a universe. We went back nearly 29 years since 1990. And we see that on average, yes, the median manager does add roughly 50 basis points versus the S&P 500. But reminder, as you notice that it's not linear. There's periods of time where technically the manager really outperforms the benchmark, and some other times he underperforms. I went through the periods that were called the second Nifty 50 by the end of the 90s. And it was horrible for certain active managers. It was not easy to add value because it was a concentrated market. It was still a top 50 names of the index that were pulling all the market up, but it's always reversal. And after that, once that reversal happens, then you see the markets go down or being corrected, and then active managers really kick in. And you, over the time, it's always the same story in a certain way, but in a different way. So you never know when it's going to kick in, when it's going to come out, but you see over time, it's not linear, and you have to manage that part there. But good managers, there is some, it's not easy, but you see on a median manager, about 50 basis points you should expect from this guy here. And the median, it's about 10 basis points over time. Now, if you look at that, then let's take the US small cap and we compare it to that benchmark, that same big benchmark, the TSX. Well, this is very strange, but at the same time, you're able to add, without obviously being such a differential on risk, roughly nearly 290 basis points. You could see that technically over time, this kind of, I would say, going into this asset class, you're able to add nearly 290 points, and it's not linear, but at the same time, you're being compensated for that kind of risk, additional risk of smaller cap names. And they're not as illiquid as they used to be. The liquidity is much more better. We're seeing things moving much easier. So usually the liquidity risk is not as high as it used to be, but still it's as non-linear and it's not as efficient maybe than the S&P 500. But at the same time, over time, it's kind of a risk that's worthwhile being taken. And you could see that you're able to add some very interesting value if you maintain your cap without panicking too much. When you talk about active versus passive, you're always classic the fundamental versus quant. Hillsdale as such is a fundamental quant manager, so we take the best of both worlds, but there's a reason behind it. When you're just a fundamental manager, you're covering a portion of the market. Example, the US market has about 2,800 names roughly. On that part there, well, a fundamental manager will only cover a certain percentage. Sometimes between 100 to 150 names will be covered. And from those names, he will be adding roughly between 50 to 75 names or holdings in his portfolio. And these will be the names he will be playing with, because usually the manager is a value guy or a growth guy or kind of GARP, but he will maintain those names and that will be the rotation. While a quant is a bit different, he will look at the universe, 2,700 names, and at the same time, his coverage will be the same amount, because for him, it's not more work. It's just he want to be sure that he has all the breadth, all the views he may have on different holdings he's able to incorporate in his model. And this will be reflecting also in his portfolio, because usually his portfolio will be between 125 to 225 names, because every time you be adding a name, he will just be compensating the risk potential of value add. So you want to be sure that for each name being added into your portfolio, he's not increasing the risk non-officially to add more value added at that in the long run. In our case, we've been managing this kind of small cap space since 1996, and the results are showing up pretty interesting. I mean, we are adding roughly 640 basis points in front of the index, the Russell 2000. As you know, it's a bit like Pete Rose. We don't do many home runs, but we're good in singles, triples, and I would say getting on the base many times. So I would say 6 out of 10 times we are adding value. So we're participating each quarter. We're maintaining a tracking error that's pretty well in line with the index, because as we know, this is kind of an inefficient index. We have to be sure that technically we do not take any major additional risk. At the same time, what we calculate versus our value add versus the risk, not the tracking error, we notice that technically our active information ratio is very good. On average, a good manager has a 0.5 and above is considered something that's able to deliver on the long run his investment objectives. And we are active, as you notice, we are 93%. So we are very, very different than an index. So we do not hug much the index. We keep it outside, but at the same time, we control risk and we're trying to add value. We're not adding more risk on the term, longer term. You see that our return risk profile is much better than the index. Our beta is a bit lower, and we have a kind of nice bull market capture. So when the market's going up, we participate. And when the market goes down, we put ourselves more in defense, and we're able to keep a certain level of more protection for your portfolio. Now, saying this is versus the Russell 2000. What are we doing versus the S&P 500? And this is the things we talked over the SSQ and all that. On the long run, since 96, we're able to match up with the S&P 500. We were able to, on average, to generate roughly 7%. These are rolling one-year numbers. We're able to generate roughly 7%, and our median is around 5%. So yes, by adding this asset class versus a passive S&P 500, we have the proof here that we're able to add some value add at that part there. But as I repeat myself many times, it's not linear. You see some blue spots, and usually that's what we say, that those blue spots do show up, and our advantage of our strategy, active strategy, is to outmatch the market, I would say 7 out of 10 times. So 7 years we should be ahead, and 3 out of 10 we should be behind. And actually, with the markets being pulled up very, very drastically by the larger cap names, we could see, since I would say the last 2 to 3 years, our strategy is underperforming, but like everything else, there should be a rebound, and we should see teams coming to our way more and more. Now, the product as such, the SSQ Hillsdale US Equity, is really something very interesting, because this has been talked over with our colleagues internally and with the guys at SSQ, is what are the advantages of adding some US small cap, and what are the limits of adding such small cap strategy into your large cap portfolio? Well, I mean, the best part in this case there is technically you're getting, like I always say, a kind of a sideline, is you're getting 2 engines for a price of 1. You're getting our US large cap core strategy that covers roughly 1,200 companies with a market cap between, I would say, 3 billion up to 3 trillion, which is Apple closely. Or plus you're getting the US small cap strategy, and there you're getting roughly another strategy that's covering the 2,760 companies out there, which have a market cap between 100 million to 3 billion. And when you're down to the 100 mark level, you're getting close to the micro cap names. So we're finding some nice, very small companies. As long as they have the liquidity to be able to be traded, kind of a daily approach and all that, they will be considered into the strategy. So this gives a view that technically by doing this, we're able to really generate a much broader perspective and much opening thing to see different companies. So we're able to add more different companies just than the ones you might find in the 1,000 or the Russell 1000. Also, both strategies are rigorous portfolio constructions. I will show you later on. And we have allocated roughly 33% to the US small cap and 67% to our core, which is a US mid-large cap stock approach. And this allocation is rebalanced very rigorously on a quarterly basis, so to avoid any kind of drift. any market drift or any unwanted risk that could be created by letting it drift over time. Because as usual, it's a bit like gambling. When you go to the casino, if you leave your chips always on the same number, you might win, but some good day you know you're going to lose. So by always taking the profits on one side or the other and rebalancing, it keeps it in place. And as we mentioned, we're managing this strategy since November 7th, 2015. So it's going interesting, but it's maintaining its cap at that part here. The reason why we came up with this kind of allocation is, as usual, if we really believe and we had the knowledge of knowing everything, we should be 100% into small cap. But that's not the reality. And at the same time, we wanted something different that's out there in the market, and talking with the individuals at SSQ and looking what kind of investment objectives we should look at. So that's where we came in with the active management metrics, our return risk metrics, and mostly what happens certain periods of times during certain crises. I mean, let's be honest, small cap does take a down dip much higher, faster than larger cap names. So can we sustain this kind of a level of risk? And by doing our models and testing all that, that's where we came up to the conclusion that an allocation of 67% to the larger cap space strategy, which is our Hillsdale core, and a 33% to our smaller cap space, this really helped us to sustain through time a very interesting return that could be something attractive to a client or prospect that doesn't have, I would say, both strategies. So by buying this product, you're getting the larger cap component, and you're at the same time, you're adding in the smaller cap component, and the person that's overseeing that, we're rebalancing to avoid any kind of drifting style risk or any marginal risk caused by being maybe too much exposed to larger cap names or smaller cap names. Portfolio construction, as I showed to you, talked about it, it's very rigorous. The process is very simple but efficient. Roughly, we covered a 1,000 Russell for a larger cap name, so everything that's over 3 billion will be considered. We have roughly 1,200 names. The portfolio on such will be about 100 names. Maximum weight is equally weighted between 1 and 1.5% maximum, so no kind of major bet on one name or thing. It's very active, between 80 to 9%. We do some rebalancing on a weekly basis, so the portfolio is reviewed weekly, and if there's some movements that have to be done or adjustments, it will be done. We try and keep relative to the index plus or minus 10% with a maximum of roughly 30% to be sure that technically we do not go extremely at the other end, such in the old days when IT or certain countries had a major percentage focus on just one sector. We try and avoid that part there. And our risk factor is between plus or 1 standard deviation in our models. As I mentioned, the larger cap space, it's less than the average day is from 1%, a bit less because they're very liquid. And the turnover, including the rebalancing part there, we're talking between 100 to 150 basis, 150%. And that's really just dollar-weighted approach and not named securities. So when you're controlling your risk, you have to trim in, trim off, and move on certain factors. On the small cap space, as I mentioned, we oversee from 50 million. So yeah, we go way, way low just to be sure that we're covering those names that will be jumping into the 100 million threshold. But at the same time, we go up to 3 billion. That's the largest cap name, other than if it's in the Russell 2000. And there is some names, I'll be honest with you, that are roughly 4, 5 to 6 billion dollars. So we will consider them, but once they get that level, we will not acquire them. We'll be more holding on to them at certain parts. Universe, 2,800 names roughly. The portfolio between 100 and 150. This is a bit different here. Our percentage between 1 to 1.5, but they will be risk return based. So we want to be sure that technically for every allocation to one of the holdings in the portfolio, the return risk is logic. It's holding up and we're able to be compensated for that part there. Active shares are roughly higher than 85%. As the other strategy is weekly, so there is some movements that will be done on a weekly basis if required. Sector plus or minus 10%. We're 100% in the market, always there, so that's good news. It's not there's no market timing on cash versus equity. Standard deviation plus or minus 1%. And in this case here, we try and keep the average day trading at 1%. So the names that we adding in to our portfolio plus the quantity of names that are there, where we're maintaining it sure that technically the liquidity doesn't dry up and we're able to trade out of those names if possible in a very short period. So on average, it's about roughly 1 day of trading and a turnover between 120 to 160%. So yes, there is some movements that be done in the portfolio, some trimming, taking profits, adding in factors, just to be sure technically we're always on a risk return base, sound and efficient to maintain over the long term our investment objectives. Now, as I mentioned to you a little while back, we're talking the market cap bias. Well, look at the example here. By just adding in the small cap component, this bias has been reduced. I mean, first of all, names superior or greater than 50 billion, we only have 22% of the portfolio allocated that versus the index, which was nearly 75%. What's interesting is by doing this, we are also reducing that weight there. We're financing the smaller names. So under 5 billion, we have roughly 36% that's being presented there. So you could see that at least by doing this, we're reducing the mega cap exposure of our portfolio, but at the same time, we're introducing the growth part that in the US market, which is much more in the smaller cap space. And if you look at it on the long term, the market cap average weight of our portfolio of the SSQ fund is roughly 64 billion versus the index, which is at $396 billion. So,
Johnny?
Yes, monsieur?
Oh, can everyone hear me?
Yeah,
Johnny,
you're
you
online.
can hear me?
Your technology is...
It's Chris Guthrie speaking, portfolio manager from Hillsdale. I just want to say in this slide, that 64 billion is still larger than the TSX composite market cap.
I agree with you. And it's even more since in US dollars.
Even in the US, small cap is larger than we think compared to Canada.
And I think you're a good point, Chris, because people always think when you get into the small cap space in the US, it's small cap, but you have a very good point. The Canadian market is a small cap space in a certain way compared to our friends down south of the US. So it's interesting to bring that out. Thank you.
Yeah, so when a client gets afraid of the word small cap, you can reassure them that the market cap of this portfolio is larger than the TSX composite. Plus,
it's liquid. That's the other part interesting. It's not static. The portfolio is just buy and hold and die with it. No, it's real. It's a liquidity. Restrictions help us to avoid that factor. Secondly, as you see on slide 30, the top 20 names of this fund are very, very different from the index. So there's not one name above 1.5%, and they're all smaller than 1%. So this I would say, balanced and much more efficient way to have more names in your portfolio than just having the top big names pulling up all the market as actually with the TSX, the S&P 500, which is roughly, I would say 4 or 5 names really pulling the whole thing up. So you have to look at that part there. It's very interesting. The other part too is it's an active product. So 80% of the fund is active. So we're very different to the market. And this helps us to do on the longer terms to generate the value add that it's expected from this strategy. You could see over sector size wise as you see times, which is interesting. If you look in the larger cap space, they will find better names in healthcare, information technology, and financials. While when you're talking to the more smaller cap names, which is interesting, is you have industrials. So this is very different. This brings in another part that technically we were talking about growth. Well, the S&P 500, not much industrials. On the other side, the small cap, there's a plentiful, very nice, interesting names, and you're able to find the best place on that level there to increase your allocation to those sectors. So you do see kind of a difference, but still, once you put both together, this 67-33, still the industrials are reduced, but at the same time, there's a weight that brings into part of technically, there's still an overweight, and we're able to find some very interesting names in those sectors, sorry. So, Chris, are you ready for your part?
I am here.
You're ready? So I'm kicking in. That's your part. Ready-os?
Outlook, yes. Everyone hopefully can hear me. You tell me, Johnny, if you cannot.
10 on 10. Obviously, 20 on 10.
Okay. I guess first point is we've 25 years at Hillsdale. It's taken me that long to train both our portfolio managers and our sales and service representatives to try and get clients into our products when they are down. That's the objective, and that's the way to make money. It's the way to get rich. It's the hardest thing to do. It is important to separate what's going on in certain funds from skill. If any manager today is losing to the S&P 500, it doesn't necessarily mean that there's a lack of skill. It might just be the structure of the fund. So we're going to go through some slides just to show you if that would ever change. Is it a good time to consider taking money out of my large cap S&P 500 or NASDAQ, perhaps, if I've been fortunate enough, US dollar holdings? Please appreciate that even a 10% allocation from Amazon or from Tesla or from Facebook is enough to make the small cap market go up a lot. It doesn't take much money. A small allocation from large to small can double the value of small cap just based on the skews that you've seen in the previous part of the presentation. So the question is, Chris, is there anything happening today that might make me think that it might be time to consider smaller cap versus large? Okay, Exhibit A, page 35. Typically, after a large correction, this is going back to 2009, but this is valid in almost all time periods, your small cap funds go down more, your small cap stocks go down more, which makes sense. They trade less, their bid-ask spreads are wider, and during periods of panic, when people sell at the push of a button, it's just there's no buyers for anything, but the fact that you're selling a smaller stock obviously makes it go down more. Typically, the rebound, as we've had on the way up, looks better for small cap, as you can see here in 2009. And that's a 1 year forward view. We're only about 6 months from maybe a bottom. But the point is, this time's been a little bit different so far, in that the S&P 500 and the NASDAQ has led small cap still year to date, S&P up 4-ish%, and small cap stocks still down 8, 9, or 10%, depending on the benchmark. So the rebound that we typically expect in small has not happened yet. Next slide. Good. Johnny, can you still hear me?
Yep, perfect.
It's set on. So this is a 2-year rolling return of small cap on the left-hand side. And then when our small cap fund started, we've tacked on our own fund to represent the small cap asset class against large cap equities. In this case, I believe it's the S&P 500. Yes, it is. So first observation, this is really maybe the only slide we have to look at all of today, is that in the last 2 years, small caps, and our fund's doing approximately the same, slightly better than the small cap index over 2 years, have lost by 40% to large cap stock. As you can see here, that's not unusual. It certainly does happen. As we like to say, small cap returns are episodic, which is the inverse of what Johnny said, as in it's for the long term. But I prefer to think about it as opportunistic, as in I don't have to own a huge portfolio of small cap stocks all the time, but I do when the opportunity presents, knowing that these companies are growing faster in aggregate than large cap companies. We'll come to that in a second. Have to at least consider the opportunity that's presented, in this case, once every 10 years. So we're now down 42% in small versus large. And of course, that's why we're chatting today. That's why this webinar exists today. Next slide. Some of what's going on behind the scenes, other than Robinhood accounts and NASDAQ and 5 names. And oh, isn't it wonderful to own more Facebook? And oh, no matter what Mr. Tesla does, I still want to own that company. What's going on behind all that, in this case, is an example of the concentration. So this slide here represents just the percent of the market cap represented by the top 100 shares of global market cap today. And we're now at 40%. And you can see there that is higher than just during the previous, call it pandemic, or in this case, financial crisis. So that concentration is a factor that waxes and wanes or comes in and out of favor. And today we've now passed the most recent high in terms of the percent of market cap that is now clustered inside 5 or 10 names in the world. And of course, most of those names are in the US, and we know them well. They're at the top of the S&P 500. While this is going on, and while people ignore small cap, it's important to note that we're not talking about taking money from an Amazon, which is a wonderful company, obviously, growing very quickly, lots of free cash flow, seems to do what it wants. Same thing for Google, Facebook, etc. We're not looking to take money off the table in terms of growth. It's one thing to be a value manager and cry wolf or cry all the time, saying that, oh, my stocks are so cheap. In our approach, of course, we're taking a core approach. So yes, our stocks are cheap and extremely cheap. In this case, on the right-hand side, you can see the different metrics compared to the Russell 2000. But the key will be to make sure that by moving for the 500 or 5 beautiful large cap names and taking 10% of that allocation and putting it in small cap, that we're not taking a discount on growth. And as you can see down about 2/3 of the way down, something called quarterly earnings momentum, which is the rate of growth of quarterly earnings. You can see in the portfolio today is 12%. Multiply that by 4 and you're at least at 50 to 60% compound annual earnings growth today in the portfolio stocks that today you can buy for, if I go back to PE, 13 times. You know, it's not only about earnings. I appreciate some people don't care. They just look at cash flows or free cash flows, or maybe it's just number of orders, lots of different metrics that get used at this point in the cycle to justify further investments in what are obviously fairly expensive companies. But for the most part, those metrics exist in our small cap fund, but even at a third to one half of the price. Notice also, sorry, Johnny, before you go on, for those clients who do care about carbon, and hopefully everybody does, or quality of management, we do take into account the density and the intensity of carbon use in the stocks in our funds. And you can see in this case that our small cap fund is less intense and has less carbon than the rest of the small cap benchmark. One way to look at the valuation, in this case we are talking about valuation. What we've done here is we've taken the history of the fund, which in this case is 17 years that we've tracked, looked at its valuation at a moment in time, and looked forward 5 years to see what the return of the fund was in the past based on the valuation at the time. And then we sort them, in this case at the bottom, as you can see, on valuation. So today at 9 times trailing cash flow, a typical expected return based on the last 17 years would be somewhere between 100 and 150% over the next 5 years. Most importantly, you can see a relationship between the valuation of the fund and its future return. These things are not always evident in the short term as we get bounced around by preferences and ETFs and button clicking traders. But over time, from any actuarial and even from a logical perspective, it does matter that you buy companies for less than pay more. And the point here is that if you're paying 18 times cash flow on the right-hand side, your future expected return should be less than if you're paying 4 or 9 times cash flow on the left-hand side. Here's another way to look at what's happening inside the S&P. We wanted to go back as far as we could. In this case, we've got, looks like about 30 years, 35 years of data to give you an idea of how close to the previous peak in valuation the S&P is. Previously, the S&P peaked at 5 times book value. And if you're old enough to remember, that was in the last tech bubble, when again, we talked about Nortel in Canada, but in the US, that was 5 tech firms, of which some of them, 2 of them are still around, and the rest are not. Many of them were hardware firms that were building the internet at the time. Our point is that today you'll pay 4 times book to get ROE of about 15% on the S&P 500 today. If I go to the next slide, this is small cap stocks. Today you'll pay 2 times book, so 1/2, and that's just the benchmark, never mind the active management. And you'll get ROE of about 4% real, which as you can see there is pretty typical for the Russell 2000. But most importantly, relative to each other, is that the red line, being the valuation in this case, is at or below the blue line, which as you can see here generally supports the valuation. Whereas if you go back 1 slide, Johnny, you'll see in this case that the red line has left the building and the blue line is falling. So in this blue line is trailing, you're absolutely right, this is trailing reported earnings. It's entirely possible that next year's earnings will bounce back to support that red line. But now you're into next year. So as an investor, you must appreciate when you buy something like this chart, you are looking for things to happen extremely well. You are discounting, it looks like at least a rebound of 1 or 2, even 2 years in profitability, and you've already paid for that. That's what this chart shows you. 2 slides down, Johnny. We also want to make sure that if we are reallocating from our client's portfolio, perhaps large cap US or indexed US, which I believe SSQ has on their platform, that we're not, again, taking money and putting it in the wrong place. In this case, you can see that on the top, we are offering a portfolio at 15 times earnings, as you can see, which compares very well to the small cap benchmark on the right at 41 times earnings. Most importantly, on the bottom, with an ROE of 14 or 15%, how do I compare to where else I could invest in the rest of the world? On the small cap side, and even large cap, a 15% ROE, if you think about it, compounding your portfolio at 15%. Remember, ROE is the return on a company's book value. That company can choose to either pay it to you as a dividend or to plow it back into the business. But either way, compounding at 15% through time is extremely profitable for everyone and does eventually make money for your clients. Here's an example of the fund's attributes through time. Yes, of course, you'll see we have earnings growth on the bottom right-hand corner, generally always superior to the benchmark, as we've showed. You can see that gap today. Return on equity, again, always superior to the benchmark, in this case, 15%. And on the bottom left, a huge gap today between the valuation of the fund and the market. Okay, I think that ends my part, guys.
Yeah,
I'm hanging out for questions if you have any. Johnny, do you have anything else to close up?
No, like I said, we cap is very simple. It's adding breadth to your portfolio. Very interesting that part there. You're getting an excess return versus higher than the large cap space. Also, diversification. We're adding more names, more, I would say, sectors more interesting than the large cap. And I see on the long run, it's always better to go active on the small cap space because this is where you get the most, I would say, expression, bang for your money. So the value add behind the small cap space is really on the active. And I think it's time for you to start considering, as Chris mentioned, at the lower end, small cap has been trashed versus the larger cap names. Well, it's maybe time to start putting more money into the small cap space because the rebound should be coming soon at that, in maintaining at that level. Questions?
Great. Thank you, Johnny, and thank you, Chris. So like you mentioned, we'll now proceed to answer some of the questions that we've had. The first question that we received, the small cap managers have underperformed for the last 3 years against the S&P 500. Could we see a reversal, and what do you think will be the trigger or the catalyst for that reversal?
Chris?
Sorry, yep, right here. Hopefully you can still hear me, yes?
Yes.
Okay. That's the best question, of course, other than just the magnitude of the difference. So if you're a small cap manager, you've been waiting for a year at least to realize this. So what makes people move? So people have to move, money has to move. We no doubt, that's the concept. Money has to come from somewhere else into small cap. And what is the catalyst for that? Many potential catalysts that we dream about. Number one, perhaps, would be simply that, as I mentioned before, it only takes a 10% profit taking or a 10% trimming of someone's large cap portfolio to make small caps go up a lot. Remember what we're talking about? Just because of the skew and the amount of money in large versus small, it doesn't take a very large movement at all to make the small cap index literally double, which is kind of where it should be, given today how valuations are in large cap space. So that's Exhibit A, just a small number. Other than that, consider what those 5 to top 10 names are. One of the reasons why they've become so large is because due to a number of events, but let's call one of them lack of competition law, which until 10 to 15 years ago was fairly aggressively applied in the US, and today has not been for a while. There are numbers of pieces of legislation quietly working their way through different parts of the US, which would control or put dents in the monopoly powers of the top 5 or 6 names that we've noticed at the top of the S&P 500. So follow that legislation carefully. And of course, a change in government would also have an effect on the concentration of those companies as well. It's not unusual for these companies to be broken up. It's happened every 10 years or so in a cycle. The US takes a very large concentrated firm and breaks it and asks it to break or forces it to break into 5 or 6 different pieces. Google did that. Smart Google did that on their own and tried to circumvent what was going to be a problem, obviously being a $2 trillion company, being the only company on the index. So concentration and or competition law, another reason that large caps could be dented. And finally, it's very difficult. It's like asking what makes social media cluster on one thing versus another. I mean, some of these companies just do bad things. Some of them are terribly governed. If you work at Amazon, in a warehouse, you probably had treated the worst of most employees in the world. There are legions and legions of stories of poor ESG practices at these large companies, particularly I'm just mentioning Amazon. And even in terms of ranking, given databases that we follow, Amazon continues to be rated one of the least quality, least well-governed companies that we know of. Same thing applies to Tesla, obviously, where one person is still in charge and that person is an exciting, evil genius. But any one of these events could, if it ever were interpreted differently, change the sentiment towards these large companies. It's more a question of if your client has been lucky enough to own these names and now has a huge part of their portfolio in them or an outsized part, can you stand the risk, given what I've shown you, of continuing to own the same amount of their portfolio or an extra large part in those 5 to 10 companies?
Okay. And we have a few more questions. With the pandemic, do you plan to make any adjustments to your investment process in terms of your small cap equity strategy?
Yeah, that's a very good question. It does apply to the root of what we do. So to give you a flavor for how Hillsdale runs its money, we do have many forecasts. Just so you appreciate, inside this fund would be a set of large cap forecasts and a set of small cap forecasts. You have a nice blend here of the two. Each of those unto themselves would have literally 8 or 9 different views or sub-strategies. In other words, oh, there we go. Thank you, Johnny. So on screen now, if you're watching, if you can still see, you'll see the different sleeves that we use in US small cap. We do have 8 strategies that are all very different, all the way from on the left-hand side. These are ordered in terms of time horizon. So my point here is that if you're a value investor or a quality investor, you were very happy to see COVID. All the stocks you had went down by half and they got cheaper. And of course, the quality, unless you had bad ones to begin with, should still be the same. It's only been, now it's a few more months, but at the time, of course, it was a very small period of time. On the right-hand side, if you were following things like trends or sentiment or momentum or changes to events or short-term changes in financings or maybe short-term changes in cash levels or balance sheets, which are on the right-hand side of my forecast, those would have an effect during any event, be it COVID or bird flu or financial crisis or mission or invasion from Mars. It doesn't matter. Our system is built to accommodate both of those scenarios, a change in a small term, a small forecast event, and a change in the long-term forecast event. What this means is that during COVID, the right-hand signals, the short-term ones, are changing quickly and affecting some of our portfolio, not all the portfolio. It enables us maybe to double down or to buy more of the high-quality value stocks, for instance, with the clean balance sheets that went down literally just as much as the other companies in the portfolio. So do we have to change anything to this approach through COVID? The answer is no.
Great. And we have one last question. Are you keeping micro stocks on your radar to include in your fund as soon as they cross your threshold line? Or will you consider adding micro stocks if they look promising prior to them crossing your threshold line?
Well, that's a good question. In Canada, we do look at them prior to crossing the line because there just aren't as many. But in the US, our portfolio has so many choices. I appreciate that 24 million can be exciting versus 25, but at some point we have to draw a line. Typically our line used to be 50. So yes, between 25 and 50, those names are certainly looked at to include in the portfolio for sure. That's still very small. I mean, in the US, that is beyond micro. We call that, what's that called? What's smaller than micro?
Nano. Yeah, but
nano cap.
Yeah. But like we said, there is one factor very important. They have to be liquid. I mean, we have to be able to trade them to be put into the portfolio. That's the consideration.
You know, the assets in small cap, we're probably running an aggregate 5 to 700 million in this mandate, in a blend or in something similar to this mandate. So at the bottom of those small names, you do have to be able to buy at least a 25 or 50 basis point weight in the name before you can approach it.
Yep.
Okay, great. So there's no more questions at this time. So this will conclude the presentation. I'd like to thank everyone who listened to the webinar and thank you for your participation. And please come back next quarter for the next webinar.
Actually, sorry, if you have one more second, there was one question about the performance, which is very kind, but I did see this. Do you want me to answer that one?
Let me just see. Yeah, I must have.
Just check your fund performance today.
Your fund,
why fund is down
year to date. Absolutely.
Yeah. I mean, it's a very, so, oops. Sorry guys, it's a very good question. It's actually pretty easy. So our benchmark for this fund is actually, although at SSQ, I appreciate we only have one we're using the S&P 500, but now that you've seen the fund, we actually internally use a blended benchmark. So if you took a blend of the S&P 500 this year, which is up about 4%, and a blend of the Russell 2000, which is actually down 10%, you arrive, actually our fund in an equally weighted basis is actually doing better than its benchmark in some strange fashion. None of those are an excuse, but the point is it is a small cap fund compared to the large cap index. So we do keep track of both benchmarks.
Yeah.
So today we'd be in between, to be, without getting too picky, both the small cap down 10 and large cap up 4.
Yeah, very good point. Thanks, Chris, for noticing that.
It should never be that far from those benchmarks unless something very extreme. And that's what's happening right now.
Thank you. And that creates the opportunity to buy also.
Yeah, that's the point. That's why we're here now, guys. To be really honest, I don't like having these opportunities pass and having no clients look at it, at least. So that's why we're here.
Great. So yeah, I don't know. Now I think there's no more questions. So again, Chris and Johnny, thanks for taking the time. Actually, just 1 second. Another question just came up. Okay, so I'll be able to answer that on our end. So thanks again. Thanks everybody and have a good day.
You too. Thanks, Matthew.
Thank you so much for having us, guys.
Hey, Chris. Thanks. Bye-bye.